Here's a fact that will make your blood run cold. 90% of retail traders lose money not because they pick bad stocks, but because they violate one simple rule that every professional follows religiously. You think you're trading. You're actually committing financial suicide. This isn't hyperbole, it's mathematical reality that separates the survivors from the casualties in the world's most unforgiving arena. The amateur sees a sure thing and throws their entire account at it, dreaming of overnight riches. Their approach is pure emotion. Greed when they spot potential upside. Panic when they witness pullbacks. They treat each trade like a lottery ticket where conviction should match bet size. This is financial suicide disguised as investing. The professional risks exactly 10% of their capital, no matter how certain the opportunity appears. This isn't conservative thinking, it's survival mathematics that separates the sheep from the shepherds. While amateurs calculate potential profits, professionals calculate maximum survivable loss. Jesse Livermore made and lost millions multiple times, but he always came back because he understood something most traders never learn. Position sizing isn't about maximizing profits on one trade. It's about staying alive long enough to catch the moves that actually matter. Livermore witnessed brilliant minds, doctors, lawyers, successful business people destroy themselves not through lack of intelligence, but through ignorance of mathematical reality. They had the right ideas but wrong execution. They understood analysis but ignored arithmetic. Meet Sarah, a software engineer with 50,000 to trade. She's smart, analytical, thorough in her research. She finds a biotech stock about to announce FDA approval. Clinical trials look promising. Management the track record. The addressable market is massive. Everything points to success. Sarah risks 50,000 to trade. She, SSM smart, analytical, thorough in her research. She finds a biotech stock about to announce FDA approval. Clinical trials look promising. Management the track record. The addressable market is massive. Everything points to success. Sarah risks 25,000, half her account on what appears to be a certainty. The drug gets rejected. Her account drops to $25,000. Now Sarah needs a 100% gain just to break even. Not 50%, 100%. This is the mathematics of ruin in action, and it destroys more trading careers than any bear market ever could. The asymmetric nature of losses is what separates professionals from pretenders. Lose 10% of your account, you need an 11% gain to recover. Manageable. Lose 25%, you need 33%. Lose 50%, you need 100%. Lose 90%, you need 900%. The mathematics become your enemy exponentially. This is precisely why the 10% rule exists, not about being conservative, but understanding that survival is priority one, profits are priority two. Sarah's story repeats millions of times. Intelligent people confuse analytical ability with invincibility. They can read charts and analyze fundamentals but can't control position sizes. They understand everything about markets except the most important lesson. The market doesn't care how smart you are if you don't respect its power to destroy capital. Consider the psychology of risking too much. When Sarah put half her account on that biotech stock, every tick against her became stress. Every headline became potential catastrophe. She couldn't think clearly because survival was threatened. Fear clouded judgment. Hope replaced analysis. She held too long because cutting the loss meant admitting she'd bet her future on being wrong. Now imagine Sarah risked only 10%, 5,000 of 5,000 of 25,000. The drug still gets rejected. She still loses money, but she's lost 5,000, not 5,000, not 25,000. She needs an 11% gain to recover, not 100%. More importantly, she can think clearly because survival isn't threatened. She can analyze what went wrong without emotional interference. She can learn instead of being traumatized. She can move to the next opportunity instead of being paralyzed by loss. The 10% rule isn't just about risk management, it's about identity. Amateurs think like lottery players. One big score changes everything. They're always seeking the home run, the 10-bagger, the trade that creates overnight wealth. Their identity ties to individual trade outcomes, creating emotional swings and irrational decisions. Professionals think like insurance companies. Consistent edge over time builds empires. They understand wealth in trading isn't built through spectacular wins, but through methodical accumulation of small edges, compounded over time, and protected by disciplined risk management. This identity difference creates entirely different behaviors. Amateurs see opportunity and think, how much can I make? Professionals see the same opportunity and think, how much can I afford to lose? Amateurs calculate potential profits. Professionals calculate maximum risk. Amateurs dream of being right. Professionals plan for being wrong. These aren't just different strategies, they're different identities. And your identity determines your destiny in markets. The 10% rule creates a fortress of emotional stability. It doesn't just protect capital, it protects psychology. It doesn't just preserve accounts, it preserves the ability to think clearly under pressure. It doesn't just manage risk, it manages the emotions that destroy more traders than any technical mistake ever could. But here's what's coming. I'm going to show you exactly how this rule transforms not just your returns, but your entire psychology. You'll discover why traders making real money are often those taking the smallest risks per trade. You'll learn the mathematical principles governing professional position sizing. You'll understand why Livermore could lose millions and return, while others lose thousands and never recover. You'll see how the 10% rule creates calm confidence instead of desperate hope. The journey from amateur to professional isn't about learning more indicators or finding better stocks. It's about understanding survival mathematics and having discipline to apply them consistently, regardless of how certain any individual opportunity appears. Let me show you the exact mathematics that separate professionals from amateurs. It's not about intelligence, it's about understanding asymmetric risk and compound survival. These numbers will fundamentally alter how you think about position sizing, because they reveal a mathematical trap that destroys more trading careers than any bear market ever could. The arithmetic is unforgiving, and it doesn't care about your analysis, your conviction, or your intelligence. The asymmetric nature of losses creates a death spiral that most traders never recognize until it's too late. Lose 10% of your account, you need an 11% gain to recover. Still manageable, still within reach of ordinary market movements. Lose 25%, you need 33% back. Getting more challenging, requiring above-average performance. Lose 50%, you need 100%. Now you're demanding extraordinary returns just to break even. Lose 75%, you need 300%. Lose 90%, you need 900%. The mathematics become your enemy exponentially, turning each subsequent trade into a desperate rescue mission rather than a calculated business decision. This isn't theoretical, it's the mathematical reality that governs every position you take. When you risk large percentages of your capital, you're not just risking money, you're risking your ability to compound returns, your psychological stability, and your long-term survival in markets. The math becomes a weight that grows heavier with each mistake, until recovery becomes mathematically impossible within reasonable time frames. Here's a comparison that will reshape your thinking forever, demonstrating why professionals consistently outperform amateurs despite often being wrong, more frequently. Two traders, same starting capital, same market opportunities, completely different outcomes. Trader A embodies the amateur approach, convinced that bigger risks lead to bigger rewards. He risks 30% of his capital per trade. His analysis is actually quite good. He identifies genuine opportunities and hits 3 winners out of 10 trades, with each winner returning 100%. That's a 30% win rate with spectacular individual gains. Let's trace his $100,000 account through this sequence. 7 consecutive losses at 30% each. 100,000 becomes 100,000 becomes 70,000, then 49,000, then 49,000, then 34,300, then 24,010, then 24,010, then 16,807, then 11,765, finally reaching 11,765, finally reaching 8,235. His account has been decimated, reduced to barely 8% of its original value. Now his 3 winners kick in. Each 100% gain doubles his remaining capital. First winner, 8,235 becomes 8,235 becomes 16,470. Second winner, 16,470 becomes 16,470 becomes 32,940. Third winner, 32,940 becomes 32,940 becomes 65,880. Final result, 65,880 from initial, 65,880 from initial loan, 100,000. Net loss, 34%. Despite hitting 3 spectacular 100% winners, Trader A lost over 1/3 of his capital. The mathematics of large losses overwhelmed even exceptional individual performance. He needed his winners to be even more spectacular, around 200% each, just to break even. Trader B represents the professional approach. She understands survival mathematics and risks only 10% per trade. Her analysis isn't quite as precise. She hits 5 winners out of 10 trades, each returning 50%. Lower win rate, smaller individual gains. But watch what happens. 5 losses at 10% each. 100,000 becomes 90,000, then 81,000, then 81,000, then 72,900, then 65,610, finally reaching 65,610, finally reaching 59,049. Her capital base remains substantial, her psychology intact. 5 winners at 50% each. 59,049 becomes 59,049 becomes 88,574, then 132,861, then 132,861, then 199,291, then 298,937, finally reaching 298,937, finally reaching 448,405. Net gain, 348%. The professional wins with a lower win rate and smaller individual gains because she understands compound survival. She can afford to be wrong more often because being wrong doesn't destroy her mathematical foundation. Each loss is manageable, each recovery achievable. She preserves capital through losing streaks and compounds gains through winning streaks. This comparison reveals the professional's secret weapon. It's not about being right more often or scoring larger individual gains. It's about mathematical sustainability that allows skill to compound over time. The amateur approach creates exponential destruction, where each loss makes recovery progressively more difficult. The professional approach creates exponential growth, where losses remain manageable and gains build systematically. Livermore witnessed this destruction repeatedly throughout his career. He watched brilliant men, doctors, lawyers, successful business people blow up accounts not because they lacked intelligence or market knowledge, but because they didn't respect the mathematics of ruin. They had superior analytical skills, deeper market understanding, more professional experience, but they approached trading like amateurs, risking too much per trade, creating mathematical impossibilities for recovery. The psychology behind these approaches reveals everything about trader identity. The amateur thinks, if I'm right, I'll make a fortune. This creates enormous pressure to be right on every trade, leading to emotional decisions, extended holding of losing positions, and premature profit-taking on winners. Fear and greed dominate because survival depends on individual trade outcomes. The professional thinks, if I'm wrong, I'll live to trade another day. This creates calm confidence, objective decision-making, disciplined loss-cutting, and patient profit-taking. Emotions remain controlled because survival never depends on any single trade outcome. This isn't pessimism, it's probability management that compounds into fortune over extended periods. The mathematics don't lie, and they don't negotiate. Professional survival isn't about spectacular wins, it's about avoiding spectacular losses while maintaining consistent positive expectancy. The 10% rule ensures you'll always have capital for the next opportunity, psychological stability for rational decisions, and mathematical foundation for long-term wealth building. Next, I'll show you the exact position sizing protocol that transforms this mathematical understanding into practical action on every single trade. Most amateurs pick a stock, then decide how many shares to buy based on available money. This is backward and deadly. They see $25,000 in their account and think, how many shares can I afford? How many shares can I afford? This approach guarantees mathematical destruction because it ignores the most critical variable in trading success: predefined risk management. The professional does the exact opposite. They determine risk first, then calculate position size. This reversal of thinking transforms gambling into business, emotion into mathematics, hope into systematic probability management. It's the difference between playing the lottery and running an insurance company. Here's the protocol that transforms everything. The exact methodology that separates professionals from pretenders in every market condition. This isn't theory. It's the precise system used by traders who survive decades while others blow up accounts within months. Every successful trader follows some version of this protocol because mathematics doesn't negotiate with hope, conviction, or available capital. You have a 25,000 trading account. Your 25,000 trading account. Your 102,500 on any single trade. This is your absolute maximum risk, no exceptions. No, this time is different. No, I'm really confident about this one. The moment you start making exceptions, you're no longer following a system. You're gambling with your financial future. The $2,500 risk tolerance becomes your North Star, guiding every position size decision regardless of opportunity, attractiveness, or personal conviction levels. You've identified a stock trading at 50. Your analysis tells you that if it drops below 50. Your analysis tells you that if it drops below 4.5. Your premise is invalid. Maybe 4.5 represents key support, a moving average, or a breakout point. The specific technical reason matters less than the mathematical reality. 4.5 represents key support, a moving average, or a breakout point. The specific technical reason matters less than the mathematical reality. 45 is where you're wrong, where you exit, where you cut losses without negotiation. Your stop loss is 45, meaning your risk per share exactly 45, meaning your risk per share exactly 5. This isn't negotiable, it's arithmetic that governs survival. The calculation becomes beautifully simple. 2,500 maximum risk, divided by 2,500 maximum risk, divided by 5 risk per share, equals 500 shares exactly. Not 600 because you have extra cash available. Not 1,000 because you're really confident. Not 300 because you're feeling conservative today. Exactly 500 shares. Because mathematics determines position size, not emotions, available capital, or conviction levels. This ensures that even if the trade hits your stop loss, and many will, you only lose your predefined 10% of capital. Let's trace what happens when you apply this protocol consistently. Your 25,000 account can withstand consecutive maximum losses and still retain 25,000 account can withstand consecutive maximum losses and still retain 8,590. That's survival mathematics in action. Compare this to amateur approaches, where 2 or 3 large losses destroy accounts entirely. The professional approach creates mathematical resilience that allows skill to compound over extended periods, turning temporary setbacks into learning experiences rather than account-ending disasters. When you risk only 10% per trade, something magical happens to your psychology. You become emotionally bulletproof. You can watch a position move against you without panic because survival isn't threatened. You can hold winners longer because you're not terrified of giving back gains that represent huge percentages of your capital. You can make objective decisions based on market action rather than account preservation fears. This psychological transformation is immediate and profound. Amateur traders live in constant fear because every trade threatens their financial future. They can't think clearly when positions move against them. They can't hold winners because they're terrified of losing profits. They make emotional decisions because their survival depends on individual trade outcomes. The 10% rule eliminates this psychological torture by making every trade survivable, every loss manageable, every decision rational. Consider Tom, a software developer who switched from risking 20% per trade to 2%. Within 3 months, His win rate decreased slightly from 45% to 42%, but his profits tripled. This seems counterintuitive until you understand the psychology. Tom's profits increased despite a lower win rate because he stopped making emotional decisions. He could afford to be wrong because losing any single trade didn't threaten his survival or his ability to continue trading. Tom's transformation illustrates the professional paradox. Smaller risks create larger profits through improved decision-making. When survival isn't threatened, you think clearly. When you think clearly, you make better decisions. When you make better decisions consistently over time, profits compound dramatically. Tom's 2% risk per trade meant he could survive 50 consecutive losses and still have capital remaining. This mathematical safety net created psychological calm that improved every aspect of his trading performance. The protocol extends beyond individual trades into campaign management. If your analysis suggests a stock could move from 50 to 5, 0 to 7, 0, you might plan a multi-stage approach. Each edition follows the same mathematical discipline, ensuring that even complex campaigns respect overall risk management principles. You never violate the core rule, regardless of how promising additional opportunities appear. This is what Livermore meant when he said, "The market is designed to transfer money from the impatient to the patient." The 10% rule makes patience mathematically possible. When you risk appropriate amounts per trade, you can afford to wait for proper setups. You can afford to let winning trades develop. You can afford to cut losing trades quickly without threatening your survival. Patience becomes a luxury you can afford rather than a discipline you can't maintain under financial pressure. The position sizing protocol transforms your relationship with markets, from desperate gambling to calculated business. Next, I'll show you how professionals use this foundation to pyramid positions, adding to winners while maintaining strict risk control. The advanced technique that separates good traders from great ones. The 10% rule isn't just about cutting losses, it's about strategic growth through disciplined pyramiding. This is where Livermore separated himself from the crowd, transforming good trades into great campaigns while maintaining mathematical safety. This advanced application of position sizing principles is where professionals maximize profits from winning positions without abandoning core risk management disciplines. More importantly, this is precisely where amateurs make their costliest mistakes, confusing hope with strategy, desperation with mathematical opportunity. Amateurs average down on losers, throwing good money after bad in a futile attempt to reduce their average cost. They see their 5-0 stock drop to 5-0 stock drop to 4-5 and think, now it's cheaper, I should buy more. This is mathematical suicide disguised as value investing. Each addition to a losing position increases total risk, while the fundamental premise remains broken. They're not improving their position, they're accelerating their destruction through emotional self-deception. The stock continues falling to 40, then 3-5, and their bargain hunting becomes account obliteration. Professionals average up on winners, but only after confirmation and only within strict risk parameters. They understand that strong stocks get stronger, that momentum tends to persist, that market leaders often exceed expectations. But they never abandon mathematical discipline in pursuit of larger profits. Each addition must be justified by market action, not personal conviction. Each pyramid level must respect the same risk management principles that govern initial positions. This isn't gambling, it's systematic business expansion based on market confirmation. Here's the professional pyramiding protocol that transforms single trades into systematic wealth-building campaigns. Your initial position follows the 10% rule perfectly. You've risked 2,500 on 500 shares of a 2,500 on 500 shares of a 50 stock with a 4-5 stop loss. The stock moves in your favor. Confirming your analysis, it breaks through resistance at 4-5 stop loss. The stock moves in your favor. Confirming your analysis, it breaks through resistance at 5-5, holds above that level, and begins consolidating in a tight flag pattern between 55 and 5-5 and 5-7. Volume contracts during the consolidation, suggesting accumulation rather than distribution. You identify a new pivotal point, a breakout from this tight flag with volume confirmation. The stock pushes through $57 on expanding volume, indicating renewed buying interest. This becomes your trigger for the first addition, but here's the critical distinction. This addition is also sized so that if the entire campaign fails, your total loss still respects your original risk parameters. You're not abandoning discipline, you're scaling it systematically with market confirmation paying for increased exposure. The pyramiding protocol follows 4 essential elements. First position, 10% risk based on initial stop loss, exactly as established. This creates your mathematical anchor, ensuring survival regardless of subsequent decisions. Add-on triggers. Clear, pivotal point breaks with volume confirmation, never based on hope alone. The market must pay you before you increase exposure. Add-on sizing. Each edition follows the same 10% rule for its own risk level, maintaining mathematical consistency across all campaign stages. Stop management. Raise stops under new structure, protecting profits while allowing normal market fluctuations. Let's trace Mira's campaign to understand practical application. She initiates her position at 5-0 with a 5-0 with a 4-5 stop, risking 2,500 on 500 shares. The stock advances to 2,500 on 500 shares. The stock advances to 5-5, then consolidates in a tight flag between 55 and 55 and 57. After the breakout above 57, she identifies her news top level at 57. She identifies her news top level at 5-4 just under the flag consolidation. Her risk on the addition is 5-7 entry minus 5-7 entry minus 5-4 stop equals 3 per share. Following the 103 per share. Following the 102,500 divided by $3 equals 833 shares for the second position. Now Mira owns 1,333 shares total. 500 at 50 and 833 at 50 and 833 at 57. Her average cost is approximately 54.25. Hurst upon the entire position lifts to 54.25. Hurst upon the entire position lifts to 5-4, protecting most profits from the initial position while allowing the campaign to develop. Net risk stays controlled, while exposure grows with confirmation. If stopped out, she loses roughly $2,500 total. The same amount she risked on the original position alone, but now with dramatically larger profit potential. This creates the professional's paradox. Your average cost rises while your risk per dollar falls. This seems counterintuitive but represents mathematical truth. Mira's average cost increased from 50 to 50 to 54, 25. But her risk per dollar of exposure decreased dramatically. Her initial position risked 10% per dollar invested. Her combined position risks less than 2% per dollar invested because the market has already moved substantially in her favor, essentially paying for her increased exposure. Winning campaigns should feel safer at larger size because the market already paid for your seat. This psychological shift separates professionals from amateurs completely. Amateurs feel increasingly nervous as positions grow, worried about giving back profits, leading to premature profit-taking that kills great campaigns. Professionals feel increasingly confident as positions grow because mathematical risk decreases, while profit potential expands exponentially. The market's confirmation validates their analysis and reduces their relative risk exposure with each successful addition. The protocol continues as long as the stock provides clear pivotal points and volume confirmation. Each addition follows identical mathematical principles. Each stop adjustment protects accumulated profits while allowing continued development. The campaign grows systematically, with mathematical safety increasing at each level rather than decreasing as amateur approaches create. You're not hoping for perfection, you're managing systematic expansion based on objective market feedback. Consider the psychological transformation this creates. Instead of hoping a single trade works perfectly, you're managing a systematic campaign that grows with market confirmation. Instead of risking everything on initial analysis, you're letting the market guide position sizing through objective price and volume action. Instead of fearing profit loss, you're protecting gains while maximizing trend participation through disciplined scaling that respects mathematical reality. Livermore's maxim rings eternally true. Cut your losses short and let your profits run. The 10% rule makes this psychologically and mathematically possible. Small initial risks ensure survival through inevitable losses. Disciplined pyramiding ensures maximum profit extraction from inevitable winners. Together, They create the mathematical framework for long-term trading success that transforms not just returns, but complete identity as a market participant. The 10% rule isn't just a mathematical formula, it's a psychological fortress that transforms your entire trading identity. It liberates you from the tyranny of fear and greed that destroys amateur accounts with ruthless precision. This transformation goes far beyond position sizing mechanics into the realm of professional identity, where mathematical discipline creates psychological freedom rather than constraint. The rule becomes your anchor in market storms, your compass when emotions threaten logic, your foundation for building lasting wealth rather than chasing temporary profits that evaporate with the next downturn. Without this rule, amateurs are paralyzed by fear when trades drop, unable to cut losses because each loss threatens their survival. They hold losing positions too long, hoping for miraculous recoveries that statistics prove rarely materialize. They're overwhelmed by greed when trades rise, taking small profits too soon because they're terrified of giving back gains, or over-leveraging into unconfirmed moves because excitement overrides discipline. Their emotions control their actions, creating erratic behavior that guarantees long-term failure despite occasional spectacular wins that fuel dangerous overconfidence and larger subsequent risks. The professional, armed with the 10% rule, makes decisions based on objective risk parameters, not fleeting emotions. They cut losses quickly because survival isn't threatened by any single trade outcome. They hold winners patiently because they can afford to give back profits without jeopardizing their future. They add to positions systematically because mathematical discipline guides expansion rather than emotional impulse. Their identity as traders remains stable regardless of individual trade outcomes, creating consistency that compounds into extraordinary long-term results through systematic application of proven principles. Here's the profound transformation that occurs when you truly internalize this principle. When you know your maximum pain is 10% of capital, you can absorb that loss without emotional breakdown. The loss becomes a business expense rather than personal failure, a learning opportunity rather than devastating setback, a normal part of the probability game rather than evidence of inadequacy. You learn from it objectively, adjust your approach systematically, and move forward with confidence intact. This is the fundamental difference between a temporary setback and permanent defeat. Consider two traders who illustrate this identity transformation perfectly. Evan traded futures with swagger and a genius label from friends. He risked 20% per idea, sized by conviction, and called it courage. 3 losses in a week cut his account nearly in half. He needed heroics to recover, so he stopped being selective and started gambling desperately. The market punished his desperation, and he quit convinced that trading is rigged. Maya began small, risking 1% per idea inside a wider 10% envelope. She waited for confirmation at pivotal points, then built size systematically. Her losers were boring. Her winners paid for the boredom and the bills. 12 months later, she wasn't a different person, just a disciplined one whose process manufactured identity and sustained results. The professional's 4 pillars create this complete transformation framework. Cut losses fast. Your stop belongs beyond the pivotal point. No exceptions. No negotiations with hope. When the market proves your analysis wrong, you accept that verdict immediately and completely. This isn't failure, it's professional discipline that preserves capital for better opportunities. The speed of loss recognition separates professionals from amateurs more than any other single factor. Because small, predetermined losses preserve both capital and psychology for the next opportunity. Size positions small. Start with 10% of intended campaign size, ensuring actual risk per idea stays around 1% of total equity. This creates mathematical safety that allows psychological calm, enabling better decision-making throughout entire trade life cycles. Small initial positions allow you to be wrong frequently without catastrophic consequences, creating space for skill development and systematic improvement over extended periods. The professional understands that wealth comes from many small wins compounded, not from betting everything on single opportunities. Wait for confirmation. Only trade elite setups where probability strongly favors success, understanding that waiting is itself a profitable position. The amateur feels compelled to always have money at risk, confusing activity with progress. The professional recognizes that cash is a position, that patience is strategy, that waiting for optimal opportunities is often more profitable than forcing mediocre trades. This discipline requires emotional maturity that comes through understanding mathematical reality and having confidence in systematic processes. Add only when paid. Pyramid positions only after market confirmation, where additions raise average cost but lower risk per dollar invested. This counterintuitive principle allows maximum profit extraction from winning trades while maintaining strict risk control. The market must demonstrate strength before you increase exposure, ensuring additions are mathematically justified rather than emotionally driven. This systematic approach to scaling positions separates good traders from great ones who build lasting wealth through disciplined campaign management. Livermore knew that the market is never wrong. Opinions often are. The 10% rule forces you to accept this fundamental truth, to respect price action rather than project personal hopes onto market movements. Your analysis might be brilliant, research, thorough, logic impeccable. But if the market disagrees, the market wins every time. This isn't personal, it's mathematical reality governing all successful trading careers. The professional surrenders ego to market truth, while the amateur fights reality until reality destroys them completely. This rule builds psychological resilience, extending far beyond trading into every aspect of life. It ensures you always have capital for the next great opportunity rather than being sidelined by previous mistakes. It transforms trading from desperate gambling into calculated business, making you a systematic capital allocator rather than emotional speculator. You begin thinking like an insurance company rather than lottery player, understanding that consistent small edges compound into extraordinary wealth over time through disciplined application. The brutal truth from our opening becomes crystal clear. You don't lose because you pick wrong stocks. Stock selection, while important, is secondary to position sizing discipline. You lose because you risk like an amateur instead of sizing like a professional. You lose because you let emotions override mathematics, because you confuse conviction with position size, because you treat individual trades as make or break moments, rather than probability experiments within systematic campaigns designed for long-term wealth accumulation. Cut losses fast. Size small. Wait for elite setups. Add only when paid. Protect the business, and the business protects you. These aren't just trading rules, they're identity principles that create lasting success through disciplined application of mathematical reality over emotional impulse, transforming hopeful speculation into systematic wealth building.